Before you buy an annuity in 2026, watch this. I'm going to answer the 7 most common questions I got all year long, and most people get at least 3 of them wrong. If it's your first time here, I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place for financial education to help you protect your wealth and generate guaranteed lifetime income so you can retire financially relaxed. All right, let's get started on frequently asked questions from 2025. This is going to be a Q&A session covering fees, caps, LTC, bonuses on annuities. But before we go there, I want to say thank you so much to those of you who helped the Retirement Income School YouTube channel hit 5,000 subscribers. The very first lesson was released in April, and it has been incredible to meet so many of you through consults and getting to know you as clients. The most popular lessons of the year have been these 3. Number 1 was the Roth conversion deadline video. If you're watching this on YouTube, I'll put the links in the show notes. If you're listening on the podcast, that's episode number 16. That lesson dives into optimizing tax strategy during the 25 to 2028 window for Roth conversions because of the permanent tax brackets. To date, there have been over 70,000 views on that lesson on YouTube. The second most popular video was Roth conversions for IRA millionaires. This is episode 19 if you're listening on the podcast, and this one has over 18,000 views. This one is a live demo of using Roth Blueprint software to walk through partial conversion numbers on a $1 million IRA. And the third most popular was Annuities, Scam or Solution. And this one to date has over 16,000 views. It's episode number 12 on the podcast. So I wanted to share those with you so you can go back and watch or listen if you haven't yet. And again, thank you so much for helping the Retirement Income School hit its first 5,000 subscribers in under a year. This is a huge success, and I'm so looking forward to helping more people in the future. If you haven't subscribed yet, do so now. Leave some comments, share it with people who you think this might help. I really appreciate you spreading the word so that I can help more people retire financially relaxed. All right, let's get into answering the most frequently asked questions of 2025. The first one is, how do annuity fees actually work? I got a lot of questions about this. Of course, I've done videos specifically around this, but I want to give a recap here. First, most FIAs, fixed indexed annuities, have 0 annual fees. There's a clean, simple structure. The reason that people buy fixed index annuities is typically for protection and growth. Now, this is going to be conservative growth. If you're looking for double-digit returns, an annuity is probably not for you. People in retirement like annuities for that protection factor because of sequence of returns risk. If all of a sudden the market tanks right when you're about to start drawing down and decumulating your portfolio for retirement income, that's going to be a problem. That's why people like fixed index annuities. Now, if you're going to have an income rider, there is a fee. So if you have a fixed index annuity with an income rider that's going to give you guaranteed income for life, then a fee would be attached to that. Typically, these are around 0.9 to 1.25% per year. This is deducted from the account value, but the benefit in exchange for this fee is that you're getting guaranteed lifetime income that can never run out no matter how long you live. This can be on yourself, single income, or joint, you and let's say a spouse. And then another type of annuity is a MYGA. MYGAs have 0 fees. These are multi-year guaranteed annuities. And currently, as an example, there's a 10-year MYGA where you can get a 5.5% guaranteed return for 10 years. What people like about MYGAs is the safety, the protection, and the guaranteed growth, and that it's tax-deferred growth. So let's say that you have $100,000 in a MYGA, it's earning 5.5%, and you just keep letting that compound year after year for 10 years. Well, at the end of 10 years, you've got compounding growth on your principal plus the 5.5% per year. This is different than, let's say, a CD where you have to pay taxes on the interest every year, so it's not tax-deferred growth. So MYGAs are great because they have typically higher rates of returns than, let's say, a CD, and they have tax-deferred compounding growth. So fees. Most FIAs don't have fees. If you're getting an FIA with an income rider, it's going to have a fee. MYGAs don't have fees. And to remind you, variable annuities carry much higher fees. I don't sell variable annuities, but let's say you have one, just be sure that you transparently know what the fees are and why you're paying them. Question number 2, what makes a carrier Roth-friendly for partial conversions? Now, I got this question a lot because, as you saw in the videos that were most watched, Roth was a very hot topic. It's a hot topic because it's important in the retirement phase of your life to start thinking about RMDs and the negative compounding effects of RMDs, IRMA charges increasing, and reducing taxes as you age, and even passing on your wealth tax-free by converting to Roth. Now, Roth-friendly carriers are unique because they allow you to do unlimited partial conversions. And what I mean by that is not all insurance carriers will allow you to do a partial conversion. Instead, you have to do a full conversion. If you have $1 million that you're converting from an IRA to a Roth IRA, this could trigger a high tax consequence. So partial conversions are typically what people choose to do. And so we use Roth-friendly carriers to do a conversion using an annuity. And these carriers also offer customized tax withholding. So you can stay in control of how the taxes are paid and avoid automatic withholding that reduces your conversion amount. Or you can decide what percentage you want to convert per year. They can withhold the taxes and pay the IRS and do the paperwork for you. Or you can opt to do it yourself. So there's a lot of customization that can happen with a Roth-friendly carrier. Another important feature of these Roth-friendly carriers is that they give you flexible transfer timing, meaning that you can move funds when it aligns for you. Let's say one year you want to do a 33% conversion, you can do that. Let's say the next year you sold a property and you have more income than you expected and you don't want to do a Roth conversion at all, you can also choose that. So it's flexible and changeable through time. And that's why when you meet with me, we create a customized plan because every person's situation is unique. And that's also why we have annual reviews to decide how much to convert, what makes sense for you in that year. Another feature of Roth-friendly carriers is that they have FIA bonuses that can support offsetting taxes. Let's say you want to do a Roth conversion, but you don't want to pay the taxes out of pocket. Well, you can take the gains and the growth from within the annuity and pay the taxes on the conversion so that you don't have to come out of pocket to pay the taxes to convert to Roth. All right, question number 3. Do I have to move my entire IRA into an annuity? Now, this applies to you if you're interested in using an annuity to do a Roth conversion of your IRA or 401k TSP. And the answer is no, you can do partial transfers. You can move only what you want to. You can convert more in some years than other years, like I said earlier. Another common way that people split their IRAs is doing annuity laddering. So you could take your IRA, split it into different amounts. Let's say it's $1 million. You take 50% and you put it into an income annuity. You start doing a conversion and then you turn the income on when you want. Maybe you do 2 income annuities so that you can turn the income on at different times. Perhaps you do an FIA, a fixed index annuity from one company and another from a different company in different amounts. Maybe you do MYGA laddering so that you can take interest from one in some years or both, or you have a 3, a 5, and a 10-year MYGA. So that would be examples of annuity laddering. And people use those strategies so that they can access their money or turn on income at different times. It could also be a diversification strategy. And of course, you could take your IRA and not convert it to Roth, and you could do annuity laddering, or you could take your IRA and use a Roth-friendly carrier and do a conversion and then pull Roth income in a laddered way. So there are a lot of different strategies of how you can take your current IRA, create tax optimized strategies, and use annuities in various ways to protect your wealth, grow it, and turn on income so that you have guaranteed income for life that could be tax-free if it's a Roth IRA income. Ultimately, you want to create a balanced plan. You want safe growth and income, sometimes without going in 100%. I have clients come to me sometimes who have $4 or $5 million in their 401ks and IRAs. Are they going to use all of that for annuities and conversions? Probably not. Ultimately, it's up to you, and we strategize together to decide what the best solution is for you. Question number 4, how long does an annuity contract take to start? I get this one a lot because sometimes people are considering how quickly they need to move if they're wanting to do Roth conversions. Perhaps they have a timeline or a deadline for tax purposes. And then it's just good to know what the timeline looks like. So when we work together, we have an initial consult and decide if it's a good fit to move forward together. Then typically we have a Zoom meeting that's an hour. We go through a process that shows a visual representation of your assets and your net worth, your liabilities, your living expenses, so we can understand your income floor and your goals. And that helps me understand which solutions would be a best fit for you. At that point, let's say, yes, an annuity is a good fit for you. Well, then we submit an application to an insurance carrier, and then it goes through a suitability process. This typically takes about 2 to 3 business days, as long as everything is in good order. And because I've worked with a lot of people, I know what creates an application that's going to be in good order, and I know if an annuity is a suitable fit for you. If it wasn't, then we wouldn't be at the application phase, because I would know that it's not possible to get you through the suitability and application process. So if you're submitting an app 2 to 3 days, we receive notification from the company that says, yes, you're good to go. Now it's time to fund. If you're funding with cash, it's considered non-qualified funds. Think of this as cold, hard cash. It's coming from a savings account, a checking account, maybe a money market account, and you're directly transferring either a wired check or electronic funds to the carrier. If that's the case, we can get an annuity app all the way from submission of the app to funding in under 7 days. Some cases can take longer, but typically it's 3 to 7 days. For an IRA, 401k, TSP rollover, qualified money, it takes longer because you're going to be doing a custodian to custodian transfer. So the custodian of your IRA is going to be transferring money to the insurance carrier. This takes between 1 to 4 weeks. 1 week would be the absolute fastest. This happens in some cases, but rarely. Typically, it's closer to 2 to 4 weeks. 4 weeks can be the timeline if the seeding company, the initial custodian where you're holding your funds currently, slows things down, which sometimes happens. If you think about how they might not want to be giving their money up to a different carrier or a different custodian, they have the right in their contract sometimes to hold it for a certain number of days. So it can take up to 4 weeks. In complex cases, it could take 4 to 6 weeks to get your app to go from submission to completion of funding. Let's say you're transferring funding from various sources and you're waiting for several transfers to go into one annuity, that might take longer. Or if there's some sort of hiccup in paperwork, so that could take 4 to 6 weeks. That's typically the longest timeline I see is 6 weeks to get from app to funding. Now, what happens during this process of application in terms of the rate locks? Well, typically when you submit an application, you're going to have a 30 to 60 day rate lock. This can vary by carrier, but that's pretty typical that whatever the terms are when you submit the application, as long as you get it funded within 30 to 60 days, that rate lock is in effect. So you're protected there while you're getting everything in order to fund the annuity app. All right, question number 5. How do cap rates and participation rates work on annuities? This is important because part of the reason that you're purchasing an annuity is for growth, potentially, or income. Both income and growth annuities are going to have cap and par rates, and these apply to fixed index annuities, not MYGAs. MYGAs are just going to have a straightforward interest rate that's based on the length of the contract, typically 3, 5, 8, 10 years for a MYGA. For fixed index annuities, they have what's called cap and par rates or participation rates. So cap rates limit the credited interest to a maximum percentage, but these are great for straightforward growth strategies. The reason people purchase fixed index annuities is because they like the bottom floor being 0. What that means is that you can't lose. Let's say we have a downturn market and the S&P goes down by 20%, well, you're going to get credited 0 that year, but you're not going to lose, which is what you want in your retirement income era or your retirement wealth protection phase. And then the way these work on the upside is, let's say there's a 10% cap on the S&P. What that means is that your annuity is tracking an index, the S&P in this case, and there's a 10% cap rate. So let's say that the S&P goes up 5%, you'll get 5% credited. Let's say it goes up 12%, you're going to get 10% credited because there's a 10% cap rate. And for participation rates, they work similarly. They give you a percentage of the index return. And these are also designed for stability. They have the same thing where they have a 0% floor, but then they have a participation rate. Let's say it's a 100% participation rate. Well, then if the S&P goes up 25%, you get 25% credited. Let's say it goes up 2%, you get 2% credited because it has a 100% participation rate. Now, an additional question here that I get a lot is, what's the difference between a bonus annuity and a non-bonus annuity? Well, with a bonus annuity, you're going to have smaller cap and par rates because in a bonus annuity, they're guaranteeing you that bonus. Let's say, for example, one of the annuities that I use a lot for Roth conversions right now, they have a day one 11% bonus that gets added to the initial premium. And then there's an end of year 4% bonus, another end of year 4% bonus, and another end of year 4% bonus. This compounds, so you're getting bonus on bonus year after year. That turns into more than a 23% guaranteed return on your initial premium. But because they're giving you that guarantee, they're going to lower the par and cap rates. They're not going to give you a 10% S&P cap if they're giving you a 23% guaranteed bonus. So that's some of the difference there. Also, some annuities that have bonuses are going to have a fee, not always, but sometimes they will. So just ask the person you're working with what the fees are, what the bonus structure is, the benefits and drawbacks of bonus fixed index annuities versus non-bonus fixed index annuities, and pay attention to the par and cap rates. And when you talk to your insurance agent, someone like me, you want to be asking those questions, and they should be very transparent about it so that you completely understand the terms of the annuity that you're purchasing. Question number 6, how does the long-term care rider work on an annuity? So first, in a fixed index annuity, what it gives you is penalty-free access. Typically, the long-term care rider on fixed index annuity is going to be included for free. There's no fee for it. And it allows you to withdraw your funds penalty-free if you can't perform 2 of the 6 ADLs, activities of daily living, or if you have a cognitive impairment. So there's going to be no added fees if you need to withdraw your money from the FIA in order to pay for long-term care needs. Another benefit of having access to your money in this way is that there's no medical underwriting in an annuity. And this is, like I said, built into most fixed index annuities. It differs a little bit with an FIA with an income rider. You still have that benefit of being able to withdraw all of it penalty-free. Or if you have a qualifying long-term care event, it triggers an income doubler. What that means is that for up to a certain number of years, often 5, they will double the income. So if you're getting $25,000 a year, they'll double it to $50,000 for the year during those 5 years while you're having the long-term care need. That's on a single income. For joint, it's typically a 1.5 payout, not always. So you're going to want to pay attention to these terms in the annuity contract, but that's what it means when we say there's a long-term care hybrid protection built into annuities. You either have access to all of your funds penalty-free, and on an income annuity, you're going to be able to turn that doubler on as long as there's still accumulation value left in your annuity. So be sure to have your financial professional explain this to you so you understand how that LTC rider on an annuity benefits you. Question number 7, how does the annuity death benefit work? For a MYGA, death benefit goes to your chosen beneficiary, very straightforward. Whatever amount you have in the MYGA, if you were to pass, goes to your chosen beneficiary. In a standard fixed index annuity, the full account value is going to pass directly to your beneficiary, and it avoids probate entirely. It's typically recommended to have a designated beneficiary as a person because it avoids probate and it makes the process very easy. That would be versus, let's say, an estate. One of the benefits of insurance contracts, this would be for annuities and whole life insurance, is that you can write the beneficiary straight in the contract and you can change them at any time as long as you're the owner of the contract. And that way it avoids probate. It's a simple process. It's just a couple pages of paperwork when you submit to the company for the death benefit. On an income rider annuity, so this would be a fixed index annuity with an income rider, there are often enhanced death benefits. Here's an example. Let's say that you're 20 years into getting paid out on your annuity and you're far past the premium amount that you've put in. There's no death benefit left because the company's paying you out of pocket and you've already made a large return on your investment because they're paying you 20 years of income and they're going to keep paying you until you pass. So there's no death benefit left. Let's say 5 years into the contract you pass, well, there's going to be a death benefit because maybe you haven't even turned income on yet. And so you want to pay attention to these numbers when you're looking at the illustration of the contract and understand how the death benefit works. Typically with an income annuity, you're thinking mostly about, I want guaranteed income for life, and the death benefit is a contingency plan because you're banking on living a long life and you're never going to have that money paid to a beneficiary because you're going to get paid for life for a lot of years. On a growth fixed index annuity, you definitely want the death benefit to be going to the beneficiary or the chosen beneficiaries. You can have multiple, you can have one, you can have a primary and contingent beneficiaries. And that's all going to be talked about when you apply for the annuity. And you can change your beneficiary designation at any time as long as you're the owner of the contract. And those were the top 7 questions that I got asked time and time again. Many times people have the wrong information. They don't understand how annuities work. They say, oh, I've heard annuities aren't great. And I really want you to rethink that and question, have you ever looked at an annuity contract? Have you ever looked at an illustration? Do you really know the difference between an FIA, a MYGA, an income rider, and a variable annuity? When people are telling you that, is it that they had a bad insurance agent who didn't take good care of them? I can't tell you how many times I have people come to me and say, my agent sold me a whole bunch of stuff and then walked away and I never talked to them again. To me, that's horrible business practice. I build long-term relationships with my clients and hold your hand the whole way through, and we meet every single year. So that matters. Vet the person you're working with. This is your hard-earned wealth. This is something you want to protect, and you want to feel comfortable with the choices that you're making so that you can retire financially relaxed. That said, if you want help with your retirement income strategy, go to retirementincome.school. You'll see a button at the top of the page that says book a Q&A call. We'll have a telephone conversation. If we want to move forward, we'll meet over Zoom, and I'll help you strategize the best fits for you for your particular situation. And last, this is the last lesson for 2025 from me and the Retirement Income School. I'll see you in 2026. I'll still be releasing a few shorts here and there over the month of December, but I'm taking a little time off in December to rejuvenate for the new year and bring you a whole bunch of awesome lessons in 2026. If you haven't yet subscribed to the podcast or YouTube channel, be sure to do so now. And I always love to see your comments. I answer all of them myself. So leave comments, leave reviews, because I look forward to helping even more people in 2026. Thank you for being here at the Retirement Income School, where I'll keep bringing you financial education to help you keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.